Welcome back. Special conversation, that time of the show where we bring in a special guest to get us a perspective on how he's looking at India. And today we have Sunil Koul, Global Emerging Market Equity Strategist at Goldman Sachs. Great having you here, Sunil, and good chatting with you. Hi, this is Harsha. Sunil, let me start off by getting a sense as to how we're placed versus global markets. We've seen a very strong rally across asset classes and across markets. The only one that has really missed out is the India market. Is that set to change likely this year over the next 12 months?
Sure, Harsha. Thanks for having pleasure to be here. Look, I think you're right. We have seen a strong rally across many markets globally, and emerging markets, as you said, are actually up 30% year to date. India has been a relative laggard. We have been sort of explaining that by the fact that India's sort of corporate earnings have been in a down cycle for a year, and valuation starting point a year back when we took the market down were more stretched. And so the combination of higher valuation with earnings in a down cycle for a year is what has sort of caused India to underperform, whereas you have had more policy catalysts in other parts of the world. And I would say, I think to your question, we are seeing at least fundamentally signs of that sort of reversing or bottoming out, at least on the corporate earnings front, wherein after a 1 year down cycle, things have kind of started to stabilize on the earnings front. And in fact, as we have been noting in our reports, the recent quarterly reporting season has actually been pretty decent, and starting to see some upgrades, especially in the financial segment. And so our general sense is that as earnings start to recover for the market, you could see FII coming back, and India could perform a little bit better than it has done so far this year.
Okay, so that's the take on how the Indian market is structured right now compared to what the global markets are doing. Sunil, hi. Also give us a sense of this FII buying that you have just mentioned. Over the last week, except for one trading day, we have seen consistent buying coming in from FIIs. Now that we have seen a reversal in terms of the market move here, valuations have come down slightly, not a lot, but they have corrected slightly. And with the GST cut, earnings now looking better than before, at least better than the previous quarter, a lot seems to be going on in favor of India. Do you believe this FII buying that we're seeing is here to stay for a bit?
Look, we certainly hope so, because you also have to look at the starting point, right? Because if you look at the emerging market pack as a whole, we have seen close to 45 billion net inflows from the April lows, which is when the market started to rally globally. But India, as we all know, sort of year to date is still minus 16 billion. Obviously, it was 17 billion before the month started, and we have seen $1 billion inflows. But you're seeing a large selling despite the rest of the emerging market getting large inflows, right? And so your starting point is pretty low. And then if you sort of start to look at FII selling over the last 1 year, which is when the market peaked in September last year, you've seen actually nearly 30 billion of FII selling. And from all the conversations we are having with clients, a lot of the data we track, I think the positioning is very light in India. If you look at the emerging market pack, India is the second largest underweight position based on the data we look at after China. And so our sense is that allocations actually are at nearly 2-decade lows for India. And so our sense is that as earnings recover, as I said, people will need to close that underweight, and allocations could improve and flows could improve in India's case.
And Sunil, how do you view the kind of rally that we've seen in global or EM indices versus India? Is there any past trend that you've been able to extrapolate or bring out, basis of which could solidify the argument that an India market rally may well be warranted? Is there any data to back this? Is there a trend to back this?
Look, I think you have to sort of look at it in 2-3 ways. One is that you have seen, at least this year, that people want to diversify away from US equity markets. And I mean, obviously, the emerging market pack as a whole has been underweight over the last 10 years and compared to US, and that has been the right place to be in. But what we have seen over the course of this year is that people want to kind of diversify away from US to non-US markets, and that's part of the flow story which we spoke about, which is why the emerging market pack has done well. Within that, we also have to keep in mind. So that's now the flow story. On top of that, you look at the macro story, which is that you're kind of looking at an environment, your US growth is slowing, but still avoiding recession, and Fed is cutting rates. So the environment of non-recessionary Fed cuts is always good for asset markets, including in EM. And you are looking at a trend where we think dollar has been weakening. It will continue to weaken. We are looking at a dollar that's 15% overvalued on our numbers still. And so if Fed keeps on cutting as we anticipate and dollar remains weak, that's a good environment for EM equities. And so with the macro tailwinds plus flow story, you're set up for a decent equity market even going forward. And the third trend there is that for the emerging market as a whole, what we have seen is a rotation across the year. I think the first quarter was largely about the European markets, wherein a lot of the EM European indices did well, Poland, Czech, Hungary, because there was a lot of excitement around the fiscal package in Germany. We came to the second quarter and we saw the Fed pivoting, and we saw LATAM markets and Korea doing well on corporate reforms. Then China started rallying, and South Africa started rallying on the gold strength. And where we are, and the laggards have largely been, as we discussed, India and some of the Middle East pockets. We are not as optimistic on the Middle East pack yet because we still have a bearish view on oil. But India has been the large market which has significantly underperformed. And I think the point I'm making is that we have seen investors rotating through markets as catalyst came through, and we are at a point in India wherein you are seeing an upcycle or starting to see at least earnings starting to inflect higher, and the market has lagged. As we just discussed, valuations are still a little bit expensive, but it's not as expensive as it was a year back, and flows are starting to come back in, which sets us up for a decent rally looking forward.
Coming in on the construct going ahead. But Sunil, I remember when we interacted at the beginning of the year, you had slashed the Nifty target from 27 to 2,500 or 25,000, yes, 25,500. Now that, of course, that mark has been breached, for now at least, where are you seeing the next Nifty target, let's say for the year end? What's the number that you're looking at?
Look, I mean, we obviously took the numbers down a year back. Our numbers are largely on the back of what the underlying earnings growth is, with a little bit of compression in multiples. So our current 12-month target, which was rolled out in September, so it's a September 2026 target, is 27,300 for Nifty. So we're still looking for despite sort of the market doing well over the last month, we are still looking for another sort of 7-8% upside from current levels, which is basically driven by our underlying 12% earnings growth and a bit of multiple compression. And so we still think Nifty goes to all-time highs over the next 12 months based on the current numbers we have. But that's largely coming in from the underlying 12% earnings growth forecast we have for India this year, and around 14% next year.
Sunil, would that at all surprise on the upside if the tariff situation were to get resolved? Or would there be any downside risk if at all the tariff situation doesn't get resolved? Is there any sense of that within those numbers? Can you give us some color? Because and how much of this is dependent on tariffs? Just trying to get a sense of that.
No, I think that's a great question. I mean, because fundamentally speaking, there is not going to be a lot of the earnings hit from the tariff numbers. We obviously have baked in some near-term uncertainty impact both in our GDP numbers as well as our earnings numbers until the year end. And so we do think that eventually tariffs do settle at a lower rate than they are currently. And we do expect things to be better next year than they are this year on the tariff situation. But to your question, I think if you sort of look at the MSCI India, which is 160 odd companies, only 2% of the sales are good sales are actually derived from US. And so even with large tariffs, you don't get that much fundamental hit, first order fundamental hit on numbers. Then you take a second order fundamental hit because the growth may slow down both in US and in India, and that has a second order impact. But all of that put together doesn't impact earnings by more than 2 to 3 percentage points, assuming that's a full 1 year annual impact of tariffs. But even if the quicker the situation resolves, the hit is even lower. So I think the point I'm trying to make is that, look, the fundamental hit to the earnings is not as great, and we do anticipate things to be improving on the trade front, as we just saw with China over the weekend. But the Therefore, to your earlier question, which is that can there be surprise on the earnings? We certainly hope so. It's not coming in from the tariff side of the equation, but it's more coming in from all the regulatory easing that we have seen through the course of this year, from mostly from the RBI side, but even on the government front, as we discussed in terms of consumption boost from GST. But just to sort of mention on the monetary side, I think our sort of strong conviction is that as we go through the sort of second half of fiscal 26 and beyond 27, you should start to see credit growth improving, because and monetary sort of financial conditions being easier, because you have seen a series of measures from the central banks, right, from rate cuts to sort of easing liquidity to a series of sort of RBI relaxation measures that you have seen in the latest policy, and the CRR cuts, which we saw earlier in June. So if you take the cumulative impact of all of that, we do think that means financial conditions could be easier going forward, and that should start to show up in the earnings.
Okay, and another thing that we're expecting to see with the earnings trickling in so far this quarter, Sunil, are any changes, if at all, you've made to the portfolio construct in terms of where you're underweight, where you're overweight? What is your stance now on sectors like pharma and real estate? And on the flip side, staples, where you were bullish earlier, and does that conviction now increase with GST coming into play?
Yeah, I mean, it does. I mean, broadly speaking, we haven't made a lot of changes to our portfolios. Okay. I mean, we were positioned overweight financials, and consumer as a cohort. And I think our conviction, both from GST rate cuts, as well as the easing measures I mentioned, has kind of increased on those sectors. Yeah, I think the staples haven't done as well because the near-term numbers, obviously there is impact from the sort of deferment of buying around the GST related changes. But we do think that as you start to get into the next few quarters, you should start to see improvement in consumption numbers. I mean, discretionary trends have already been starting to look better, and as I'm sure we are all tracking all the festive data points that have been coming in, which doesn't get captured in the reporting season, but they're also starting to seem very strong. And in some cases, the numbers are looking at sort of multi-year highs. And obviously, there's a bit of pent-up demand impact, but it does feel like the discretionary consumption is starting to improve. And then, as I said about the financials earlier, we do think all these measures that have been taken that relaxes or eases the credit constraint for the banks close to 2 percentage points of the total bank credit. And many of the measures that the RBI has taken are effective for 2027. So we think we are in a 2-year upcycle for the financial sector, and then you get consumption on top of it. So both those two sort of groups of the sectors together is a meaningful portion of the equity index. So we are overweight financials, which includes banks and NBFCs. We are overweight consumption pack, which includes autos, staples, some of the discretionary consumption. We also are overweight the internet pack, which has the tourism related theme, and so it picks up consumption as well. And we have been underweight, and we are overweight OMCs, which is more a bearish oil view. So those are the three main packs we are overweight on. And then we have, in terms of our funding areas, mostly coming in from the export-oriented sector. So we are underweight pharma, to your question, and we are also underweight industrials, ex of defense, because defense to us is still a secular theme and a global theme where companies and where countries are investing and trying to be self-sufficient. But barring defense, we are underweight the broader industrial pack and underweight some of the export segments, including pharma, because the reason for that, it's not entirely on trade, but it's more on the fact that if government continues to consolidate on fiscal and they are giving all the boost in terms of consumption, we think at the margin, to make the fiscal math work, they will still need to moderate infrastructure spending, which is why we think, relatively speaking, within the market, it makes sense to be more positioned in financials and consumer cohorts as opposed to some of the exports oriented sectors or the investment oriented sectors.
Sunil, do things materially change where IT is concerned? And change maybe since over the last 6 months, has the view on IT materially changed? Because now you have tariffs in the new as part of the new equation that you need to factor in, and you also have AI. as part of the new equation you have to factor in. And how does one look at or marry these three and look at IT? Give us a sense.
Yeah. No, look, I think you're right, because the outlook on the IT sector does look a little bit more murky in the near term, because as you said, you have a higher input or higher kind of cost you need to bake in because of the H-1B visa impact. There is already a slowdown in the U.S. economy and discretionary spending, and our sense is that that the labor market in U.S. is still weaker. Obviously, we have absence of data right now, but from all the higher frequency data we are tracking, we think the economy will continue to slow through the course of the year. And so we still have some growth headwinds for the IT sector from a slowdown in US spending. You bake in the increased visa costs, that also makes the things a little bit tougher. And then, as you said, there is the broader AI debate, wherein a lot of the investors think that Indian IT space could at the margin be impacted because of that. Obviously, we are still not at a point wherein the adoption has increased to a meaningful level across, and productivity impacts have come through across the global markets in a meaningful way. But at the margin, a lot of investors still believe that IT could be impacted adversely. I think the tougher call from a market standpoint we have is that the sector has underperformed quite a bit over the last 1 year relative to the broader market. And so our sense is that it doesn't make sense to be underweight the pack, which is why we are neutral, the IT sector, and we think selectively you may want to be positioned in some of the better related names, which also are starting to make investments in data centers and trying to be viewed as an AI player. But for a broader sector overall, we still think growth will be sluggish, which is why we are more neutral to the IT camp.
Is the stance coming in on IT. Sunil, great to have you on board and get all of these views from you. Appreciate you joining us. Thanks so much for your time.
Thank you so much.
Okay, so that was Sunil Koul of Goldman Sachs sharing his view on where he sees the Nifty headed, what are some sectors that he's liking at the moment, and the overall market construct when it comes to India and how it is globally placed. But on that note, we'll slip into a very short break and keep the conversation going with our experts on the other side.